Thank you guys for joining. My name is Mark Lamonica. I look after the individual investor team here in Australia. Today we're going to talk about market crashes and then lessons that you can learn from market crashes. So yeah, while you're following us on Instagram, you can hopefully learn something. So, and if anyone is interested, this is the first of 2 webinars we're doing today. So we've got one going in at 6 o'clock as well, where we're talking about portfolio construction. So if anyone wants to sign up for that one, let me know. You can email me at mark.lamonica1@morningstar.com if you would like. All right. So far we have 3 new Instagram followers, which is exciting. I'm getting messages from the team, so that's good. All right. So as I said, we're going to talk about market crashes today and lessons we can learn from market crashes. But first, we have our housekeeping items. So anything you hear today is general advice. I obviously can't offer you personal advice since I don't know anything about you. For our friends in New Zealand, you can go into morningstar.com.au to get a copy of our FAP. And the New Zealand regulatory authorities would like to remind you to go to a financial advisor if you do want personal advice. All right. With all of that out of the way, I will say I would love questions. So there's a Q&A button at the bottom of the Zoom screen, or there's the chat functionality. So send in any questions you may have. And yeah, let's get started. Oh, somebody's saying no vision. Let me see if I can, hopefully maybe that helps. Yeah, let me know. Okay. Let's get started. So I'll go back to better. Okay, good. Look at that, problem solving. That's once again our Instagram account. Okay, now I can't advance the slides. There we go. Lessons from the past. We're going to look at market crashes, and that's me. All right, so we're going to look at 3 different market crashes today. One that was a long, long time ago, and then some market crashes in the more recent past. We're going to start with railroad mania. So railroads, obviously very, very exciting. So let's talk a little bit about what this is. And as you can read, first commercial railroad, 1830 over in England. And the railroad mania, so obviously railroads started to be developed across England, and we hit railroad mania in the 1840s. So what's the first thing that happened? And that may be a recurring theme here. The Bank of England cut interest rates in the early 1840s. So that lowered financing costs. Railroads, of course, were very capital intensive, took a lot of capital to actually build them. So that was good, lowered financing costs. And also we had a little bit of a revolution in terms of accessibility to the market. So this is a recurring theme that you're going to hear. Middle-class investors in England started investing in, but also obviously the railroad. So nice little system they had set up that you just had to put down a 10% deposit. And obviously to raise all of this capital that the railroads needed, they thought, okay, I can go out to retail investors, the retail investors of the day, middle-class investors. And so very soon, half of all the ad space in newspapers was marketing railroad shares, try to get people to invest in them. So that's a little bit of the environment. So of course, what happened? All right, a couple things happened. Number one, a group of quote unquote professionals were brought in to determine the future traffic assumptions for different railroad lines. And what they were obviously replacing from a passenger standpoint is they were replacing horse-drawn carriages. And so what they decided is originally they said that they thought double the horse-drawn carriage passengers would be supported by a railroad. But all of a sudden we get into a situation where we have to justify these big investments we're making. So everyone decided that that was too conservative. And then they said quadruple, so 4 times the amount of traffic that took horse-drawn carriages between 2 different areas would then, they assumed, would then ride the new railroads. All right, so this, of course, by changing this justification, that, of course, got more people to want to build railroads, because if we're agreeing with this 4 times traffic, then you can justify a lot of things. So between 1844 and 1846, you can see that 10,000 kilometers of rail line were built just in those 2 years. And I went back and I looked at the UK rail network now, and it is 16,000 kilometers. So pretty good. More than half of that was laid in 2 years. But then, of course, things go wrong, which is why we're looking at a crash here. So in late 1845, as you can see, interest rates went up. So the Bank of England raised interest rates, and people started thinking, oh, there's some alternative ways to invest, namely bonds. And yeah, that did not help the boom in any way. And as you can see, in 1845, 2/3 of railroad shares went down by 2/3 compared to when the mania started in 1835. So a couple other interesting things. So you needed an act of parliament to create a new rail line. There were 263 of them in 1846. And they actually proposed routes that were totaling 15,300 kilometers. Now, about a third of that, as you know, was never built because the companies collapsed, either because it was completely ridiculous proposition to build this railroad, or they turned out to just be fraudulent enterprises. So we always see a lot of fraud around booms. The other thing that I thought was interesting, at least, is during that decade of the 1840s, 36% of England's GDP went into railway development, which is a lot. So yeah, couple facts, but the whole point of this thing is we want to get lessons about investing. So let's see what we have. Okay, couple lessons, and then we're going to get into some more lessons about more recent market crashes that we've had. Yeah, be very careful when people keep moving the goalposts to justify share prices. So we'll see this in 2 crashes from now when we look at the .com crash, but we see this all the time at the top of markets, that people just change the rules. So traditionally, you would value shares in one way, value an investment in one way. Now, all of a sudden, we are changing the way that we look at things just to justify what's happening. And of course, in booms and bubbles, there is no way to justify it. But as humans, obviously, we want a narrative and we want a rational reason why things are happening. So we often do come up with these justifications. But once you start seeing people do this, be very, very careful. So of course, in this railroad example, what happened is it was moving the goalposts in terms of the amount of traffic you could expect on a line, which is very, very important. And this stuff happens all the time. We saw the same thing, and we'll talk about this in the 2000 crash, particularly around all of the fiber optic cable that was laid. So there are these wild projections for what internet traffic would be, and that justified companies like WorldCom and Global Crossing building these networks all over the place. Well, guess what? Something like 5% of it was used when those companies collapsed. So just be very careful about these projections and think about, the whole point of going back and looking at the past is we want to think about lessons that may apply today. So think about some of these projections that we're seeing. I'm not saying they're wrong, but I'm saying just take them with a grain of salt around things like electric cars, for example, all these projections that are justifying huge investments into new technologies. So this other bullet point I think is also really important and applicable today. So transformative technology can still be a really poor investment. So as I said, investors are drawn to narratives. We're all drawn to narratives about every aspect of our life. Well, one of the problems here, of course, is that just because a technology is adopted does not mean it makes a good investment. And valuation is a really, really important lesson here. So if we go back and we look at the railroads specifically, obviously railroads transformed the way England and the rest of the world operated. So this was a transformative technology. It was also a really, really bad investment. And the reason for that is it's hard for us as investors. We always like this sort of straight causation between, okay, railroads are going to be a great new technology. That means railroad shares are going to do well. Well, a lot of this disruptive technology can actually benefit different parties other than the party that's actually building them. So we see this all the time, right? So sometimes consumers benefit through cheaper prices. Sometimes other companies that utilize this technology benefit. Sometimes it's the suppliers that are actually, in this case, supplying the steel and wood and whatever else is needed for railroads. So what happened with this railroad boom? Well, at the end of the day, what this did is it did transform England. It led to and helped the Industrial Revolution. So basically, England changed from more of an agricultural-based economy into this industrialized nation because the railroads brought all of these efficiencies. They reduced production costs, and they helped build up a middle class that actually purchased all of these new goods that were being manufactured. Now, in this case, that disruptive technology benefited others other than the railroad. So just be careful. We don't actually know who the beneficiary is. Just like if we go back to that WorldCom and Global Crossing example, who laid all of these network cables that facilitated the growth of the internet. Well, who benefited from all that? Not those companies. They went out of business. Who benefited from it was all the companies that were now able to deliver data or deliver products that involved large amounts of data very, very cheaply over these networks. So namely, think of Facebook, Google that owns YouTube, all of these things that require cheap and abundant networks to deliver. Well, those are the companies that actually benefited, and those are the companies that came out of that era. Oh, we got some good questions already. Okay, we're gonna move on to the next one. So yeah, keep the questions coming. I'll go fast through this stuff, and then we can spend time with questions. We're going to talk about the Nifty-Fifty. So we've got two quotes here, one from Warren Buffett and then one from President Nixon. So what are they talking about? Well, globally and in the US, the 1960s were times where the stock market was a time where the stock market did very, very well, and eventually turned into a bubble. So we've got Warren Buffett. So remember Warren Buffett, after he finished up business school, he started his own investment partnership, which he closed in 1969. You can see his quote there is, basically he said, I don't understand what's happening in the market. It doesn't make any sense to me. I can't invest anyone's money. Now, the market did not crash for 3 more years, so this was early, but that was Buffett's reaction. And then, of course, we have the classic, everybody piles into a bubble, and there's Nixon in 1970 saying if he had any spare cash, he would put it into the economy. So what is, or into the market. So what is the Nifty-Fifty? So the Nifty-Fifty were 50 growth stocks in the US. You can see some of them down at the bottom of the screen, the companies that obviously still exist. And it was not a particular industry or sector. It was this diverse range of companies. They were mostly consumer goods, and they were mostly non-cyclical companies. So basically meaning that as market cycles changed, there were products that were still sold, which makes sense if you go through this list, right? So, McDonald's generally not moved too much by market cycles, Coke, Pepsi, got J&J, Merck, Pfizer, so drug companies, things that are necessities. Pfizer, very much a necessity right now, but things that are necessities that go throughout these market cycles. So all of these were very high quality companies as well. So this wasn't kind of our typical speculative bubble that happens around maybe disruptive technology, new companies, companies that don't have a lot of history, maybe don't have strong finances. All these companies had well-known brands. They had strong balance sheets. But the problem was that what happened in the Nifty-Fifty, as we'll go into this, is that these all became what were known as one decision stocks, which basically means that, hey, you just go in there and buy them no matter what. So a couple other things happened during this bubble, which happens in every bubble that we should talk about. So number one, obviously valuation levels went up significantly. You can see by 72 of these 50 stocks, close to a 42 price to earnings ratio, where the S&P 500, the 500 largest stocks in the US, was below 20. And then, of course, you had sort of the most speculative of these. So Polaroid selling at over 90 times earnings. But hey, people at the time, oh no. I was trying to move something on my screen that did not go well. So yeah, other thing obviously is prices go up, dividend yields go down. So right now we have one of the lowest dividend yields overall in market history, but of this Nifty-Fifty, dividend yield was less than half of other big stocks. And then all of a sudden, right, something happened. So what happened? Well, namely, what happened is we did have an inflection point with interest rates in late 72, and all of a sudden it led to the worst downturn since the Great Depression. So the S&P 500 went down 42%. You can read this, obviously, close to 6 years to fully recover. In the UK, it took over 13 years to recover. The market did get extremely cheap, of course, so this was an opportunity if you waited for this. But one of the things that we see, one of the hallmarks that we see in every single bubble, is that we see giant inflows of capital, new investors into the market. And generally, that is retail investors. So you should be a little bit wary when you see giant inflows of retail investors, which should sound familiar if anyone's watching what's going on. So you can see right here from 1960, and this was the age of mutual funds, because we're talking about the US here, but managed funds. So you have these star managed fund managers that were tracking all of these assets. So this actually is supposed to say 1965, not 1065. So 1 year before, William of Orange sailed across to the UK to get ready for the railroad mania. But now 1960 to 1965, the assets in mutual funds doubled. They doubled again in 70, and sure enough, they peaked right before the crash happened in 1972. All right, geez, I'm a little trigger happy with the mouse today. Okay, so let's talk about what happened. So there was a study done by Jeremy Siegel. So Jeremy Siegel is a professor at, I believe, at Wharton at the University of Pennsylvania. And he went back and he looked at these Nifty-Fifty companies and figured out what happened. He did this study in the late 90s and looked at what happened between their peak, so in December 1972, their peak, and then when he did this study, or the time period he did it, to August 1998. So interestingly enough, and we'll get into the lessons, the Nifty-Fifty, even though they were at such high valuation levels, and even though they went through such a crash in 73 and 74, overall, they performed pretty well. So you can see the S&P 500 annualized return, once again, starting at below 20 from a PE ratio, annualized return of 12.7% from that peak to 1998. But the Nifty-Fifty did pretty well. So rebalanced Nifty-Fifty, what that basically means is an equal amount goes into each of the 50 stocks, and then every year it's rebalanced to make sure that all of the different shares in there, once again, hold an equal amount. 12.5%. The non-rebalanced Nifty-Fifty, so we just let it run, 12.2%. And we see a number of companies on here that outperformed the S&P 500. So one thing I will say is these are all the companies. This is the list of the companies, which should all look familiar to you. This is a list of the companies that outperformed. Now, think about it. We had 50 companies in this index. Not all of them still exist, but this is a pretty short list. So they definitely dragged up the overall market return, sort of led by Philip Morris, which was outperforming by more than 6% a year over that time period. So, it was the winners that dragged this thing up, but still interesting that overall, these shares did pretty well, and they did fall significantly. So the biggest losers in the Nifty-Fifty in 73 and 74, Xerox went down 71%, Avon down 86%, and Polaroid went down 91%. So we did see really, really stark falls in these shares. All right, so what are some lessons? So one really important lesson that we can all take from this as investors is that great companies with sustainable competitive advantages, or moats, can grow significantly faster than the overall market. So if we go back and look at this, you can see every one of these companies, except for GE, has a wide moat from our analysts. Now, our analysts, to be fair, we're not rating them back then. Morningstar did not exist back in the 70s. So Morningstar started in 1984, and our equity research started later than that. But these are all wide moat companies with sustainable competitive advantages. You can see their earnings per share growth was significant. So a good lesson, and one of the things that Buffett always talks to us about, is finding companies with these sustainable competitive advantages. And you do have to pay more for companies that are great companies and are growing faster than the market. The question, I'm going the wrong direction. The question, of course, is how much more do you have to pay? And we were looking at examples from the peak of the market, but if you would have waited a little bit until the market went down, or if you would have purchased them earlier and held on, you would have done even better. And that's that second bullet point, is just remember that these great companies, you are not going to be the only one that figures that out. So that you are going to pay for growth, that you are going to pay for that sustainable competitive advantage. So valuation levels could be higher, and in this case, we're justified for a lot of them. All right, so we're through two. Moving on to the dot-com crash. So one I actually remember, despite how old everyone on my team thinks I am. I was not around for Railroad Mania or the Nifty-Fifty. All right, so hopefully people are more familiar with the dot-com crash. So what happened? Well, here we go. We've got a couple quotes on here. We've got, of course, Alan Greenspan. This is his famous irrational exuberance quote, which is, okay, somebody just wrote, nope. Don't know what that means. This famous irrational exuberance quote. And then over here, and we'll talk about this in a second, or we'll talk about it right now, the CEO, so this guy, Michael Hartley, is the CEO of something called Cheap Tickets. So Cheap Tickets is one of these new online travel companies. And that quote around hurting his valuation refers to one of the biggest boondoggles in the dot-com crash is Priceline. So Priceline, same business model, basically, online travel agency where you can go buy flight tickets. So Priceline went public in March of 1999. So remember, this market peaked about a year later. So about March 2000. So went public at $16 a share. On the first day, it went up to $88 a share, which gave it a market cap of $9.8 billion. So that was the largest first day valuation of an internet company. In the first 2 quarters, Priceline managed to lose $142 million. And basically what they did is, this was their business model, is they went out and they had to buy tickets, so airline tickets, after they had already sold them to people. And they ended up paying a lot more and losing $30 on every single ticket that they bought. So not a great way to run a business. But at the time, what they were doing is they were driving, of course, lots of traffic because their prices were cheap. And there were other people like our friend Michael Hartley here at Cheap Tickets, who of course could not compete with that because he was trying to make money on every ticket he sold, which is, a key part of business. But this went very well for Priceline because everyone just decided that none of these old valuation techniques mattered. And what mattered was the amount of traffic you had on the site and volume. All right, so a couple things that we can look back to .com crash about. Okay, what happens in market bubbles? You have lots and lots of IPOs. So those are initial public offerings. Of course, as equity markets do very well, people think, okay, time for me to cash in on my business that I've started and get some of this equity capital. So you can see here, 486 in 1999. And you do get a hangover, of course, even into 2000 when the market did start falling in March. You get lots of new IPOs, a level that we have not reached yet, but there are 407 in 2020. Now, I just took a look, and there are different sources, but I just took a look before this started, and we're up to, some sources are saying 490 this year already. Now, a lot of these are SPACs, so these special purpose vehicles that are being that are coming out, but still, just something to think about. That, of course, when equity markets do very well, when there is a speculative frenzy, lots of companies decide this is a really good time to go public. Not such a good time to go public when markets are doing very poorly. So we've got a couple of the poster children for the .com crash. I won't go through them all. We have boo.com. That is this very well designed website right here. So Boo.com, they were going to be Amazon before there was Amazon, but they went out of business because they went through $135 million in cash in 2 years. So yeah, not great. This is Webvan. So Webvan was going to deliver things to people's houses, something we all are aware of right now. They had $1.2 billion in market cap and 4,500 employees, and they went bankrupt in under 2 years. And then yeah, this Pets.com, this little sock puppet thing, is another one that was going to deliver dog food to people. Now, of course, think about it. All of this stuff happens now, of course, but these companies were way too optimistic in what they're actually doing, were definitely ahead of their times, and yeah, did not do so hot. All right, why is this thing not clicking? There we go. Oh, geez. It was not clicking, and then it went nuts. So I did want to just highlight a couple great stocks and show what has happened with some of these valuation levels. So CISCO, still a huge company and a company that's done very well lately, as you can see. But if we look at CISCO and we go back, so CISCO had the highest price to earnings ratio among the 10 biggest stocks. If we go back to 2000, 196, which is pretty high, right? So 196, and its price to earnings ratio now is 14.39. So over this time between 2000 and beginning of 2021, they grew their revenue by 160%, 5% a year, pretty good, but not so good as a shareholder, right? You still lost 36% if you would have bought it at the peak, even though the company did very well. Why? Because of the valuation difference, right? That valuation difference of going from 196 from price to earnings ratio way back down to 48. So remember the different parts of returns. We have increases or decreases in valuation levels, we have dividend yields, and we have growth. In this case, growth, and they pay a decent dividend now, growth and dividend were wiped out by changes in valuation levels. So something to think about. Microsoft. So Microsoft, really great company, a company that has performed amazingly. So I took this to 2016. So even though it was a great company, even though a lot of good things happened to Microsoft, namely beating some of the antitrust suits they had against them, from 1999, the end of 1999 to 2016, you can see it basically broke even. So it was up like 2.65%. During that time period on here, they grew revenue by 361% a year, 10%, or 361% in total, or 10% a year. But the price to earnings multiple went from 74 times earnings to 35. And back in 2016, it was a little under 30. And Microsoft has done very well since then. But just another example, once again, of how valuation matters. When we go back and look at the dot-com bubble, the fact that all of these, anything internet related, had these huge valuations, it's impacted investors for a very long time. And it particularly impacted new investors that got into the market. So we once again saw a huge influx of new money that went into the market. A lot of this had to do with sort of online trading, which was a new thing at the time, but something to think about. Same thing when we see these speculative bubbles, that a lot of new money goes into the market. So I don't belabor these, but this is our friend Amazon. So Amazon, it took till 2007 basically to recover. And yeah, it lost 90% of its value in 2 years. So another example of very, very high valuation levels and what's happened to a company that has done very well. All right, so let's go through some lessons and then we will do some questions. I want to leave time for questions today. Since the last time we ran out of time. Of course, the time before that, I left time for questions and we never got to them all. Okay, so let's look at some lessons. So speculation in the market in this case was certainly more widespread. So it was very concentrated in that Nifty-Fifty run up and then crash in those 50 stocks, more widespread in 2000. And yeah, things went a lot worse. So the NASDAQ fell close to 80%. Just remember that. So when we get into these areas where people say the market's never going to go down, and if it does go down, it's going to be 10% or something like that. It can fall significantly. We just talked about this. So valuation levels, even for those great companies, which I just showed you, can lead to very long periods of poor returns if you're buying something that's too expensive. The other thing that we saw is think about, if you are a passive investor, think about where your exposures are. So if you look at passive investing right now, and the same thing happened back in 2000, is that when there are these huge run-ups in certain sectors, they of course take over more of these passive indexes. So even passive investors who think they are not making a quote unquote bet on anything, they actually are. So if we go back in 2000, the information technology sector started that year, and remember, we're like 3 months from the market crash, started that year at 29% of the index, ran up to 35% of the index, so the S&P 500. But after year end, we had a huge fall, made up 21% of the index, and then went down. It bottomed in 2003 at 14% of the index. So what does that mean? So that means even as a passive investor, because we had this, even though it was more widespread, but we had this sort of concentrated technology bubble, as shares do well, they make up more and more of an index. So as a passive investor, if that quote unquote bubble pops, very specific part of it, it's going to drag you down because it's going to be more and more of the index. So just something to remember. The other thing that's important is that there was a shift, and we've talked about this before, there was a shift from growth into value. And value actually did pretty well. So value shares, where you did not have these technology companies, did pretty well during this period. So that, of course, is an example of the whole market did not do terribly, just a very specific part of the market, and passive investors who are overexposed to this specific part of the market. And then finally, we've got of course the fact that retail investors piled into the market in the year 2000 and got very, very hurt by this. So, you know, we started, of course, seeing all of these proclamations that this time is different, and a bunch of retail money went into the market. So be careful when you see this speculation. So I've got some figures here that I was sort of desperately trying to find with all my pieces of paper. So over the course of the year 2000, remember this is when things started to go south. $260 billion went into U.S. equity funds in 2000, and that was up from $150 billion in 1998, $176 billion in 1999. And while this was happening, all the tech companies, of course, were cashing out. So insiders sold $43 billion worth of shares at the end of 1999 and 2000, and that's twice the rate they had been selling. So yeah, the insiders cashing out, replaced by retail investors going in there, which ended very, very poorly. So something to think about. Remember, all of these very speculative market bubbles generally start with retail investors. Anyway, we're on Twitter now, so you can find us on Twitter. I'll show the slide later, but thank you guys for joining. I'll see some of you tonight.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.